Hey everyone, and welcome back for another deep dive. Today we're dissecting a recent article called IPO SPAC Market, the brutal, beautiful comeback of 2025. The IPO and SPAC markets were pretty dismal in 2022 and early 2023. Remember that crazy drop in IPO volume? It was something like 61%. And SPAC deals, forget about it. They practically vanished. But this article suggests a comeback is brewing in 2025. So we're going to unpack what's driving this resurgence and, more importantly, what it could mean for investors like you.
It's quite a turnaround, isn't it? To understand it, we need to revisit what caused the initial crash. The article uses a very apt analogy, a cocaine-fueled fever dream, to describe the IPO and SPAC boom of 2020 and 2021.
Okay, I'm intrigued. Cocaine-fueled fever dream, huh? What exactly does that mean for those of us who weren't part of the Wall Street party scene?
Well, think back to when interest rates were practically zero. Borrowing money was incredibly cheap, and investors were flush with cash. They were pouring money into anything that seemed remotely promising, even companies with shaky foundations. So kind of like those stories we heard about companies like Nikola promising the moon with electric trucks they hadn't even built a prototype of yet.
Exactly. Or Lordstown Motors with their electric pickup truck that, well, never really materialized. Both companies reached valuations in the billions before the market woke up to the reality that they were more hype than substance.
So what changed? Why did the music stop so abruptly?
Entered the Federal Reserve.
Yeah.
To combat rising inflation, they started raising interest rates. That made borrowing more expensive, and investors suddenly became a lot more cautious. It was like someone turned the lights on at the party and everyone realized things had gotten a little out of control.
Makes sense. When money gets more expensive, people think twice about where they invest it, right? So how did this impact the IPO and SPAC scene specifically?
Dramatically. With investors becoming more risk-averse, growth stocks and speculative investments like many IPOs and SPACs lost their appeal. The IPO pipeline practically froze over. Going public suddenly meant facing the harsh reality of a much lower valuation than companies had hoped for.
So everyone hit the brakes.
Essentially, yes. Private companies stayed myopic, private venture capitalists held onto their funds, and the market went quiet.
But now in 2025, the article suggests a comeback. That's a pretty big shift. What's fueling this renewed interest?
Well, the article points to a couple of key factors. One is what they call pent-up demand. There's a huge backlog of companies that have been waiting for the right moment to go public.
This pent-up demand you mentioned, can you give us some concrete examples of who's waiting in the wings?
Absolutely. Think about companies like Stripe and SpaceX. They've achieved unicorn status valuations over $1 billion while staying private. But their investors eventually want to see returns, and the public market offers that liquidity. Then there are companies like Chime, a fintech player that's been quietly generating substantial revenue, and XAI making waves in the AI space by actually building tangible technology, not just riding the hype.
So it's not just a matter of companies wanting to go public, but also needing to...
Precisely. Many of these companies have reached a point where they need access to the public markets for continued growth and to satisfy their investors. And as the article points out, the current market conditions might just be the right moment.
Okay, so we have a potential convergence of necessity and opportunity. Companies need to go public, and the market might be ready for them. But what about SPACs? They were kind of the poster child for the IPO craze and subsequent crash, right? Do they have a role in this comeback story?
That's a great question, and the article does address it. Remember, the previous SPAC craze was like the Wild West, full of speculation and unfortunately some bad actors. But things have changed. The SEC regulations introduced in 2024 brought much-needed structure and accountability to the SPAC world.
So the stock Wild West got tamed a bit. What kind of regulations are we talking about?
Well, for one, there are stricter disclosure rules. SPACs now have to be much more transparent about their sponsors, their targets, and their financial projections. This makes it harder for companies with questionable track records to sneak through the back door.
So more accountability and less room for shady dealings.
Exactly. And there's also increased liability for SPAC sponsors. If they make false or misleading statements, they can be held personally responsible. This has definitely weeded out some of the less reputable players.
So SPACs are potentially back on the table, but with more safeguards in place.
Right. And the article points to companies like Lucid Motors, an electric vehicle manufacturer, as an example of a SPAC success story. Despite some early production challenges, they're now ramping up and aiming for significant deliveries in 2025.
Interesting. So it seems like both traditional IPOs and SPACs are contributing to this potential comeback. But let's be real, not every company is going to be a winner, right?
Absolutely. As the article wisely points out, this isn't a rising tide that lifts all boats. There will be clear winners and losers in this new IPO SPAC landscape.
Okay, so who's likely to come out on top? And who should investors be wary of?
The winners in this case will be the companies that can demonstrate solid fundamentals. Think real revenue streams, a clear path to profitability, and a strong management team.
Like the Chime and XAI examples you mentioned earlier.
Precisely. Companies like those with a proven track record of success and a realistic growth strategy are well positioned to attract investors.
So substance over hype this time around?
You got it.
Yeah.
On the other hand, companies clinging to the outdated playbook of 2021 are likely to struggle. Those relying on inflated valuations and lacking a sustainable business model will find it much harder to convince investors to open their wallets.
So no more WeWork-esque situations where a company is valued at billions only to collapse when the hype fades.
Hopefully not. Investors have learned some hard lessons from the past, and they'll be much more discerning this time around.
I imagine Wall Street is watching all of this very closely. What's the article's take on the investment banks? Are they eager to jump back into the IPO game?
Oh, they're definitely sniffing around, sensing opportunity. They saw their fees dry up when the IPO market stalled, and they're eager to get back in on the action.
But they'll be proceeding with caution, I'd imagine.
Absolutely. The emphasis this time is on quality over quantity. They'll be scrutinizing companies much more carefully, ensuring they have the fundamentals to support a successful IPO.
Makes sense. They can't afford to back another high-profile flop that could spook investors and derail the entire recovery.
Right. They need to rebuild trust in the market, and that means focusing on companies with solid track records and realistic growth prospects.
Okay, so we have pent-up demand from companies, cautious optimism from investors, and a more discerning approach from investment banks. Sound like a recipe for a potential comeback, right?
It certainly does. But the article is careful to point out that it's not all smooth sailing ahead. There are still risks that could throw a wrench into the works.
You know, we love to look at all sides of the story here on the Deep Dive, so let's talk about those risks. What could potentially derail this IPO SPAC comeback?
Well, for one, the global landscape is still quite volatile. A major geopolitical event, like an escalation of tensions between China and Taiwan, could send shockwaves through the global economy and make investors skittish.
That's a good point. Geopolitical risks are always lurking in the background.
And then there's the Federal Reserve. If they mismanage interest rate adjustments, say by keeping rates too high for too long, they could stifle the recovery before it gains momentum.
So the Fed's actions will be crucial to watch.
Absolutely. They need to find that sweet spot where they're controlling inflation without choking off economic growth. It's a delicate balancing act.
What about company-specific risks? Anything investors should be particularly wary of?
One thing to watch out for is the disconnect between the valuations some companies are expecting and what investors are willing to pay. The article mentions Discord. The gaming chat app is reportedly seeking a $15 billion valuation. That's a hefty price tag in a market that's become much more risk-averse.
So a potential clash between inflated expectations and a new reality.
Exactly. If companies can't adjust their valuations to reflect the current market sentiment, it could lead to stalled IPOs and a slowdown in the entire process.
Okay, so a lot of potential, but also a fair amount of uncertainty. How does the article suggest investors, founders, and anyone interested in this space navigate this complex landscape?
The key takeaways are: be informed, be prepared, and be realistic.
Sounds like solid advice. Can you break that down a bit?
Sure. First and foremost, do your research. Don't get swept up in the hype. Look beyond the headlines and dig into a company's financials, revenue growth, cash flow, debt levels. It's the boring stuff that often reveals the true story.
So don't just buy into the sizzle, make sure there's some actual stake behind it.
Exactly. And diversification is key. While the tech sector might seem like an obvious place to invest, remember that other sectors, like industrials and healthcare, might offer hidden gems.
Don't put all your eggs in one basket, so to speak. What about SPACs specifically? Any advice for those considering that route?
For SPACs, it's crucial to look beyond the celebrity endorsements and flashy presentations. Focus on the sponsors.
Yeah.
Their track record, their experience, their skin in the game. Are they truly invested in the company's success, or are they just chasing a quick buck?
Great point. And what about advice for founders who are thinking about taking their companies public?
Founders need to be strategic about timing. The article suggests that the second and third quarters of 2025 look particularly promising after potential rate cuts, but before the noise of the upcoming election cycle starts to dominate.
So strike while the iron is hot, but choose your moment carefully.
Exactly. And of course, make sure your company is in top shape before going public. Clean up your books, cut unnecessary expenses, and perhaps most importantly, set realistic valuation expectations. Greed can be a fatal flaw in this market.
Don't overestimate what the market is willing to bear.
Right. And don't underestimate the value of experienced advisors. Someone who's weathered previous market downturns can provide invaluable guidance and help you avoid costly mistakes.
So surround yourself with people who've been there and done that.
Exactly. Now, for those who want to stay ahead of the curve, the article offers some excellent practical advice. Track the data. Pay close attention to Federal Reserve announcements, CPI releases, and IPO filings.
Those filings, especially the S-1 forms for IPOs and the details of SPAC mergers, can be treasure troves of information, right?
Absolutely. They can reveal a lot about a company's financial health, its growth prospects, and its overall strategy.
And don't forget the power of social media. Following financial experts who cut through the noise and offer insightful analysis can be invaluable.
Remember, knowledge is power, especially in a market as dynamic and unpredictable as this one.
Okay, so we've covered a lot of ground here. We've looked at the factors driving this potential IPO SPAC comeback, the risks that could derail it, and the advice for navigating this complex landscape. What does it all mean? Is this comeback a sure thing, or are we setting ourselves up for another fall?
Well, I think the article makes it clear this isn't a simple yes or no situation. It's more like a cautious maybe with a big asterisk for all the potential pitfalls we've discussed. What do you think?
I completely agree. The 2025 IPO SPAC market is fascinating because it's driven by both opportunity and necessity, tempered by the lessons learned from the recent past. It's not just a repeat of the 2020-2021 frenzy. We've got companies that need to go public to fuel further growth or provide returns to their investors. We have investors who are eager for opportunities but are also more discerning after the recent market turmoil. And then we have investment banks that are eager to facilitate these deals but are also taking a more cautious quality over quantity approach.
Precisely. It's a very different landscape than what we saw just a few years ago. The cocaine-fueled fever dream analogy the article used is pretty spot on when you think about it.
Yeah, that one really stuck with me. It captures the irrational exuberance of that period, but now it seems like everyone is a bit more sobered up and realistic.
Exactly. And that's a good thing. It leads to more sustainable growth and hopefully prevents another painful market crash.
So if you were to distill all of this down to the most important takeaway for our listeners, what would it be?
I'd say the key is to approach this IPO SPAC comeback with informed optimism. Don't let fear keep you from exploring potential opportunities, but don't let hype cloud your judgment either.
I like that. Informed optimism. It's about finding that balance between being excited about the possibilities and being aware of the risks.
Right. And that means doing your homework. Understand the market dynamics, research the companies you're interested in, and pay attention to the broader economic and geopolitical context.
All the things we've been talking about today.
Exactly. Use the resources the article mentioned. Track Fed announcements, monitor CPI releases, study those IPO filings. Knowledge is power, especially in a market like this.
And remember, this isn't just about picking individual stocks. It's about understanding the bigger picture, the trends that are shaping the financial landscape.
The IPO and SPAC markets are a reflection of the overall economy, and by understanding how they work, you gain a deeper understanding of the forces driving innovation and growth.
So as we wrap up this deep dive, I want to leave our listeners with one final thought-provoking question to consider. Given everything we've discussed today, the potential, the risks, the advice, what indicators will you be watching closely to make informed decisions about the IPO SPAC market? What signals will tell you it's time to jump in or perhaps to step back and wait for a better opportunity? Keep those questions in mind as you navigate this exciting yet unpredictable financial landscape. Stay curious, stay informed, and until next time, happy diving.